Recording in progress.
Hello everyone. First of all, let me introduce myself. My name is Wahyudi Akbar Sugeha and with NPM 214111090. I'm from Teknokrat Indonesia University. Specifically, I'm from Faculty of Economic and Business. Right now, I will explain about financial ratio formula and calculation. The first one, solvency ratio is one of the financial ratio used to measure the ability of a company to entity to meet their financial obligations. The solvency ratio provides an overview of the extent to which the company is able to pay its debt and survive the long term. There are several commonly used solvency ratio, including debt to equity. The formula is debt divided equity. This ratio measures the extent to which a company relies on debt to fund its operation. The higher this ratio, the higher the financial risk of the company. The second one, debt to total asset ratio. The formula is debt divided total assets. This ratio measures the proportion of debt in the company's capital structure. The higher this ratio, the greater the company's dependence on debt. And the last one, we have interest to earnings before interest and tax. Interest coverage ratio. The formula is earning before interest and taxes divided interest expenses. This ratio measures the company's ability to pay interest on its debt. The higher this ratio, the better the company's ability to cope with interest expenses. The ratio above are examples of solvency ratios that can be used to evaluate the financial health of a company. A good understanding of this ratio can help investors, creditors, and management make better financial decisions. The second one, we have liquidity ratio. Liquidity ratio is one of the financial ratios used to measure the ability of a company or entity to meet its short-term financial obligation using assets that can be quickly converted into cash. There are several commonly used liquidity ratio, and the two most popular is current ratio and quick ratio. The first one, we have the current ratio. This ratio measures the ability of a company to meet its short-term obligations with current assets. The formula is current ratio equal current assets divided short-term liabilities. In this formula, current assets are assets that can be quickly converted into cash within 1 year or the company's operational cycle, while short-term liabilities are liabilities that must be settled within 1 year or the company's operational cycle. The second one, we have quick ratio. This ratio is a variation of the current ratio but is more conservative as it only includes the most liquid assets in its calculation. The formula is quick ratio equal current asset minus inventories divided short-term liabilities. In this formula, inventory is excluded because inventory cannot always be converted into cash quickly in emergency situation. These two ratio help financial analysts and other stakeholders in assessing the liquidity of the company. The higher the liquidity ratio, the greater the company ability to meet its short-term obligations. However, keep in mind that too high a liquidity ratio could also indicate the company may not be using its asset efficiently, as it has too many liquid assets that are not generate maximum profit. The second one, we have activity ratio. Financial ratio are analytic tools used to measure the financial performance of a company or business entity. Here are the formula for some of the financial ratio that is activity ratio. The first one is inventory turnover. Inventory turnover ratio measures the efficiency in managing inventory of stock of goods. The formula is inventory turnover ratio equal net sales divided average inventory. The second, we have the receivable turnover ratio. The receivable turnover ratio measures how quickly the company collects receivables from customers. The formula is receivables turnover ratio equal credit sales divided average receivables. The third one, fixed asset turnover ratio. The fixed asset turnover ratio measures how efficiently a company uses its fixed asset. The formula is fixed asset turnover ratio equal net sales divided average fixed assets. The last one, we have total asset turnover ratio. The total asset turnover ratio measures the efficiency with which a company uses all of its assets to generate sales. The formula is total asset turnover ratio equal net sales divided average total assets. It is important to remember that the result of each of these ratios can provide insight into how the company is managing various aspects of its finance and how efficient its operations are. The next one we have probability ratio. Financial ratios are important tools used to analyze the financial performance of a company. One type of financial ratio is a profitability ratio, which measures the extent to which a company generated profits or gains. There are several commonly used profitability ratio, and here are some of the formulas. The first one, we have net profit margin. The formula is net profit divided total revenue times 100%. This ratio measures how much net profit is generated by the company from each unit of revenue received. The second one, we have return on asset, ROA. The formula is net income divided total asset times 100%. This ratio measures how efficiently the company uses its assets to generate profits. The third one, we have return on equity. Net income divided shareholders' equity times 100%. This ratio measures the return on investment received by the company's shareholders. The fourth one, we have gross profit margin. The formula is gross profit divided total revenue times 100%. This ratio measures the extent to which the company generated profit from the sale of products or services after considering production costs. The next one, we have return on investment. The formula or ROI. The formula is net profit minus initial investment divided initial investment. This ratio measures how much profit is generated compared to the initial investment spent. The sixth one, earning per share or EPS ratio. Formula is net income minus preferred dividends divided number of shares outstanding. This ratio measures the profit available for each outstanding share. The last one, we have operating profit margin ratio. The formula is operating profit divided operating income times 100%. This ratio measures how much profit is generated from the company's core operations. This is important to remember that each probability ratio has different uses and interpretations, and the results need to be analyzed in the context of the industry, company size, and purpose of the analysis. In addition, the result of profitability ratio should be compared with various periods or with similar companies to gain the better understanding of the company's financial performance. That's all for me about financial, or how to calculate the financial ratio. So that's all from me. Next to meet you at the next video. Thank you very much for the watching. Don't forget to subscribe. Thank you very much.
Recording stopped.